Hello and welcome. You're watching The Investing Edge. I'm Sumaira Abidi. Investors today are no longer content with just a one-dimensional approach to investing. They want a lot more. They're looking at portfolio diversification, more efficiency in tax planning, better alternatives in terms of passing on wealth to the next generation, and perhaps even philanthropy. The Investing Edge is the answer to all of these questions and much more. With me is Feroze Azeez, Deputy CEO of AnandRathi Financial Services. Feroze, thanks very much for joining in for yet another episode of The Investing Edge. And to begin with, before we talk about investing, I want to talk about the current environment that we're investing in. There are global worries that are going on. There are slowdown worries in India itself. There's the recent debt market scare that investors have seen. Therefore, what should be a holistic investment strategy at this point?
I completely agree with you, Sumaira. As we progress, the world is going to become more and more complex because it'll all be jumbled up. So it's going to be difficult to ignore risks. Risks are very important because that's the only thing you control. Returns you can only pray for. Risk is the only thing you can keep an eye on and mitigate. The risk is that there is artificial money in the global market. It's not real liquidity. Half the Europe has negative interest rates. You give your fixed deposit to a bank and he returns 99 rupees as against 100 rupees. That's like unimaginable from an Indian context perspective. Of course, the liquidity has been far more than it deserves to be, is why you have such low interest rates. Okay, there could be supply shocks. If China stops doing trade with the US, there could be supply shocks. So inflation can shoot up and still interest rates can be low. So there are quite a few risks which are there. You have to only worry about risks if you don't have a strategy. If you have been buying products, you have to be really worried because there was no risk target. Do you have a risk target? How do you measure the risk? How do you put a target to it? If you have a target and you've controlled the risk, it's okay. There are 4 risks you need to be concerned about. How are they measured? What is your measurement? What is your interpretation of those measurements? And what is your mitigant? How do you reduce those 4? If you have not done that activity, or if your advisor has not done that activity adequately enough, then the risk can impact you. Strategic approach helps you be lesser worried because you can have risk limits. Second is, you should always have a plan A and a plan B. If equity markets don't do well and something catastrophic happens, what is my plan B? If you have these two, then these external risks are going to be there. If you keep going 10 years, every year there was some risk or the other. Right? So you have no choice but to live with them and maneuver them safely.
That's true. Actually, a lot of people think that they're in the business of delivering returns when actually they're in the business of actually just managing the risks better. But since you've spoken of risks, let's talk about some of the risks in our environment, right? You spoke of interest rates, but let me take that point forward now to bond yields. In India, the benchmark bond yields, have come down swiftly, now below 6.5%, I think 6.3 or thereabouts. What is the debt strategy for an investor in this environment where yields are falling? As well, the debt funds themselves have come under question because of, some credit risk events, et cetera, et cetera. Therefore, how much place does debt have in a person's portfolio now?
Is debt important? In India, debt is very important. Why is debt important? Because it gives you 8% interest, 9% interest. So it is high enough to be attractive to be a part of the portfolio. Right? So debt is an important part. One method to make money is to lend to people who give you higher interest rate. That's called credit risk strategy. That's called credit risk strategy. The second way to make extra money in debt is called interest rate risk strategy. The third is to dynamically manage it. We think debt in our portfolio should be there for safety. Don't play around too much with debt because the purpose of debt itself is to provide safety. Risking your safe capital is itself counterintuitive. So point 1 in our debt strategy is don't take risk in the component which is supposed to infuse stability. So in debt, don't take risk is the first step. Second is, invariably, you will automatically get credit risk. There is no choice. In debt, you have to your credit risk automatically comes. Interest rate risk is a choice. If you take credit risk, make sure that you are lending to 150 companies, not to 10 companies, 20 companies, 100 companies. If you can in effect lend your money to 150 companies, if 4 of them went down under also, you know 146 of them are alive to pay you back your money. When you buy debt mutual funds, which are a very good vehicle, you can only see the name of the fund. But inside that fund, the fund manager has lent to 30 companies, 40 companies. Only seeing the name is not enough. Seeing the underlying instrument inside the wrapper, like you have a wrapper which is called the mutual fund. What are the companies inside? So now, for example, now my portfolio has 8 credit risk funds. If you buy those same 8 credit risk funds, you will get 170 companies. You have lent to 170 companies. The top company itself, the biggest money is lent to a company where I've put only 4%. So even if the largest company whom I've lent to, I've lent 4%. If it goes bankrupt, it'll hurt me, but not so much that it'll break my back. So diversification is the strategy. Interest rate risk should not be taken. There is a mathematical evidence to it. Interest rate risk is one of the most meaningless risks to take. Quite a few people recommend that: income funds, dynamic bond funds, GSEC funds. Mathematically, you know that it's a zero-sum game.
Feroze, I've heard you say so often that people keep buying products all their life. They don't know what to do with it. Everybody comes to the product, they buy it. I know that you only have preference for 2 or 3 products, right? Why don't you like real estate? Why don't you like, other products from these 17 or 18 product categories that are available? Why are you fixated with just the 2 or 3?
We realized that none of these are good for our clients because we went the full circle. Between 2004 and 2012, AnandRathi did a lot of exotic stuff. So we did all that and we realized this is very experimental and the client is not benefiting enough. And in fact, we stopped the real estate fund, and I commend my promoter and I take immense pride. We got a negative view 5 years back on real estate, which today everybody agrees real estate is in shambles. 5 years back, we wrote articles and we became very negative because data was saying so. AIF's not good, PMS not good, ULIP's not good, right? Real estate funds not good, mezzanine lending to builders not good, perpetual bonds not good, right? So, and there is enough evidence, okay? It's not off the cuff, okay? In fact, buying and selling stocks, direct equity for a long-term investor is detrimental. This is product classes. If you just eliminate this, your return will go up to 3%. You don't need to know what you need to do. You just need to know what not to do.
Okay, so what's the outlook now going ahead? You've narrowed down on the products. Does the investing style or strategy change with the changing environment? Does that remain static? Is there some sort of hedge that's required?
If you can identify trends and invest and incorporate them in your strategy, what are the trends? Clear trends. One trend is markets will be driven by domestic liquidity. Why? Because 10,000 crores is going to be spent in educating people on what mutual fund is. 10,000 crores in the next 10 years. So what is going to happen is when you're educating people, there are only 2 crore Indians who invest in mutual funds out of 138 crore people. In the US or any emerged market, 50% of the population invests in mutual funds. So with this kind of expenditure, will there be 10 crore investors in the next 10 years? I think so. Second trend is India is going to be far, far, far more tax compliant. Identify trends, don't be worried about news. If you know what are the 4 or 5 trends which are very, very high chance, then if you incorporate them in your strategy, you'll be okay. Second, how do you monitor? And how much do you monitor? So a full-fledged review of your strategy every year, monthly review with an advisor is a very good practice where your next generation or your spouse is sitting along is a good frequency of review.
On that note, we'll take a very quick break. We'll come back and answer all of our audience queries in just a bit. Do stay tuned.